Hello, thank you for joining us today for another edition of our podcast, Wealth Transparency. We have on our usual Andrew Tang, who's the Chief Information Officer for Turner Financial Group, Michelle Connell, who is the President of Portia Capital Management based in Fort Worth, and a first-timer, Ray Micaletti, who is the Chief Information Officer for Ethos Financial Group. I'm Ed Butowski, and what we do with Wealth Transparency is we take headlines that don't necessarily make it to the front page, but talk about what impact they're going to have on your portfolio. So to cut right to it, last week we talked about freight demand was weakening rather faster than retail sales. Andrew, will you kind of give us a little bit of your thoughts on the weakening freight demand and what that impacts financial markets?
Yeah, that really has to do with the disruption of the Strait of Hormuz. We see the disruption of goods trading between different nations on parts as well. But as a whole, we see manufacturing activities actually starts to creep up. But when you do the count of freight numbers, we did see a slight lowering number, but we believe that this is going to be a short-term scenario and not an indication to a recession, for example.
Okay, and Ray, what are your thoughts on freight demand and retail sales?
Well, I do think that Andrew mentioned that he doesn't think this will lead to a recession. And today the GDP number came out. It was about 1.6%. Growth seems to be kind of mediocre. Everyone expected it to kind of rebound after the Q4, which was surprisingly low, but they attributed that to the government shutdown. Q1 was supposed to rebound. It really hasn't rebounded. And, to his point about the Strait of Hormuz, that it has caused a lot of disruption. And, we're really not out of the woods there yet. The price of oil has stayed low primarily because we've been draining the strategic reserves around the world. And from what I understand, there's only maybe a month or 2 more months that we can do that. So if this doesn't get resolved before then we could see even more freight demand destroyed if oil rises. But if we can resolve it in the next couple months and oil prices come down, then we probably see the economy rebound from there. I think that a lot of people have talked about this, that we have sort of a bifurcation in the consumer. The top maybe 10% is doing very well, carrying the economy. The bottom, 80 or 90% is struggling. And, with the rise in prices and inflation increasing, that's not helping. And also the AI spend has really been, carrying the economy. So if we don't get the freight situation or the oil situation, fixed, and if the AI spending somehow kind of wanes a little bit, given sort of the profit models of these AI companies, then we might see additional slowing, but I don't think we're there yet. So I'll let someone else have the floor.
So Michelle, do you see a global recession coming as a result of the Strait of Hormuz and the slowing down of freight demand?
On the other side of the slowing of the freight demand, you're also seeing some capacity work its way out of the system. From what I've read, we had some excess capacity, and so that is decreasing. At the same time, demand seems to be uneven. On the trucking side, you have less people or less individuals that want to participate in that. So there's some choppiness that's being added to the capacity situation in terms of freight, some exterior demand and supply that is weighing on the system. But regarding your question on recession, I don't think we're approaching a recession. But I think what is happening, you're continuing to see the GDP numbers from around the world get compressed in terms of expectations, especially in Europe and Asia, because they're more affected by what's going on in the Middle East than we are. We're very fortunate, but we may have eventually some lower expectations for our gross domestic product as well if this continues in the long term.
So from an investment standpoint, for those watching, I would be looking at ZIM, which is an Israeli freight company. Starbuck or Starbulk is another one that I really like. Are there any, Andrew, Ray, or Michelle, that jump out at you as really good investments as a result of the freight demand weakening, but the idea that we're 6 to 9 months ahead of earnings and economic data, so right now they might be in the low point of their cycle?
I don't really have any ideas in the freight or storage area, but I think you're going to see some players enter the field like, I'm trying to think, it's called Grub Market that has an IPO coming on board this year. And what they do is they use, because there's such a dispersion or a lack of communication between all the truckers and the freight and the railroad in our country, they're using AI to kind of have some connectivity between all these separate parts. And I know they're looking at going public, I think, in the third quarter of this year. So I think they're going to be interesting because we just don't have a way for all the trucking and especially on the restaurant and on the food side to speak to each other. And so Grub Market will allow there to be some connectivity and again, using AI to do that.
And logistics companies like the former i2 Technology that now is, I think, Blue Wanderer bought JDA. I think logistics companies are going to be good buys. So Andrew, let's talk about tariff revenue. There's always this discussion about tariffs coming into the United States, but the majority of the money on tariffs come from companies that are in the United States. So if Samsung brought in a washing machine from Mexico, the government of Mexico doesn't pay that tariff. Samsung in the United States would pay for it, or Westinghouse. So the idea that we're getting all of this money from these other countries just is not factually supported by reality, is it?
Yeah, no, so far from what we have seen is that the middlemen in here are absorbing the cost. And so you see distributors as well as resellers, they have been flipping the bill and they have been absorbing these costs so far because ultimately the consumption market, it's really dictated and controlled by consumers. Consumers will tell the sellers or the manufacturers how much they will pay for the goods through sales demand, for example. And so far, what most people were expecting is a jump in inflation due to the tariffs that were imposed. We so far haven't really seen that yet. However, when the situation got worse with the conflict of Iran, and then you all of a sudden have supply shipment shortages, and the manufacturers are not getting their goods, for example, then they took this opportunity to collectively increase the prices. So we're starting to see the price are creeping up on the consumer end. And if the conflict continues longer, it's going to give more of a reason for the suppliers and the middlemen businesses to continue to inflate the prices. And so, yeah, that's not a good move.
So Ray, what's your observation about the tariffs and how much money is being brought in, and is this a real boondoggle for the United States?
Well, if we are generating $200 billion in tariff revenue against $40 trillion in debt, it's somewhat of a drop in the bucket, although around the edges, it's $200 billion less of bonds that you have to issue. So I guess it's good in that sense, but I think it's also just this very intractable problem where we essentially hollowed out our manufacturing base, and it's a national security issue. Like, we don't even produce our own defense equipment. All of that supply chain runs through China. So how can you have a conflict with China if they can just shut off, what they make for our weapons and systems? So I think it's a national security problem where you have to bring the manufacturing back, and tariffs are one probably crude tool to try to subsidize bringing manufacturing back. But if our companies are paying it, it's not really a smooth, clean issue, but it's something that we have to deal with, at some point. So we let it go to a point where now it's difficult to reverse, but because we are trying to reverse it, that will probably argue for a weaker dollar. Inflation is likely going to be here to stay at least the next 5 to 10 years. So yeah, the tariff revenue, it's kind of a drop in the bucket, but it's probably a necessary step that we have to take.
So that kind of brings me to the global growth forecast that falls in line a little bit with what you were saying, Ray, about, we're seeing forecasts drift a little lower, which makes sense because you're seeing the world economy slow down, maybe not a global recession. But what do you see, because I know I've read a lot of your stuff and I follow you quite a bit, and I think that there's not a doomsday scenario, but you're not very positive on the world growth market.
Well, I would say that if we're talking about markets and sort of what's going to happen with markets, because ultimately knowing what growth does or what any economic data does is only a means to kind of understanding what the market's going to do. That's the end point, because you can't trade GDP, you have to trade the market. So I think that we're seeing earnings were very strong, and we also had people that were positioned very sort of bearishly because they thought the Iran war was going to have very negative outcomes. So everyone was hedged to the downside. We got a ceasefire. Everyone unwound their hedges. It drove the market straight up, and earnings were spectacular. So we kind of had this vertical move, but vertical moves aren't sustainable. At some point, it will retrace. Now, I don't know when it will retrace. It could be next month. It could be next year. But we should expect at least the rate of ascent to calm down. And if it doesn't, that would be a little bit scary, because then it would say that we're really in a mania, and we could have a violent reversal at any time. So I think that where things are priced, the next decade could be lost for the U.S., probably better for international, probably exceptional for commodities, given the global competition for resources in order to win the AI race, in order to develop the latest weapons. They all require rare earths, silver, copper, etc. So yeah, I would say that, am I bearish? I'm not really bearish tactically now, but look out 5 or 10 years. I don't think U.S. equity returns are going to be that impressive relative to non-U.S. equities as well as commodities.
So Michelle, the International Monetary Fund continues cutting its outlook. How viable and how influential is the IMF? And do you agree, as Ray was saying, that we're going to see a slowdown in the U.S. on GDP?
I don't know how viable it is. I know that people pay attention to it. I think it's a data point. But I think what they're saying bears some evaluation, because we have seen a slowdown in Europe, because they do have much higher inflation due to what's going on in the Strait of Hormuz. The Middle East is probably going to have much lower growth, especially in the near term. Even if the Strait of Hormuz was to open up immediately, it's going to take 6 months to a year for them to really get up and going. So I think the Middle East will also have lower growth, and Asia as well, because they've been dependent upon what goes through the Strait of Hormuz, as we've talked about in past podcasts. So in the near term, I think the United States is still the place to invest. I think the AI boom, because I had to write on it recently, is in front of us for probably at least another 5 years and change if you look at past industrial revolutions. But then, yeah, we'll probably have some stagnation in terms of growth after that build out is complete.
So Andrew, you're very much into the technology side of things. Do you think technology is going to help the United States stave off some of the pending negativities of global growth?
Yeah, I strongly believe that. And, echoing what Ray said, I think it's really important to reassess the macro environment and the spending patterns, and also our capital markets, and also the valuation of the current investments with stocks and bonds and so on. So that is absolutely, we need to review that, especially with the balloon debt that we had. We're very close to $40 trillion. And so, yes, we can grow our way out of that situation. But in terms of your question, where is the opportunity when it comes to investing? And I also have to agree with Michelle, is that it's not Europe, it's not Asia. Europe is still, again, very much tied down by their over-regulations policies. They're regulating themselves out of any other growth opportunities. On top of all that, you don't have a good capital markets, and you can't really foster and nurture any growth in there, and that's why they all come to the United States. They all come to Silicon Valley. And so what about Asia? Well, Asia, especially in China, they're still not recovered, okay, from the monstrous real estate bubble that busted. They depended way too much on real estate investments, and that really fed that balloon to be so big that when it did pop, the whole country is devastated. They're still suffering through a spiral of deflation. Nobody really wanted to invest. All the foreign investment companies left. And then now what do you have? You have a consumption market that is not sustainable by itself. And that's why Asia right now, they still are going through this crisis. And so if Europe is not the destination, Asia is not the destination, at least not yet, you really have to believe that United States is the place to invest right now. And when it comes to this AI infrastructure build out, I have to honestly say we are still very early into this, build out. And there are multi layers that are involved. It's not just chips. We're talking about the energy layer. We're talking about construction layer. Within the last 2 years, we have used so much more cement, okay, than the last previous 5 years. And so because of this build out, you also have electricians that are putting systems together, cooling as well. So this whole AI infrastructure build out is lifting the entire economy because it has multiple layers that are benefiting, the country as a whole.
It's funny, I just got back from Italy and I asked people who spoke English in Italy, what was the last invention from Italy? And no one could tell me anything because money isn't rewarded by going there. Just like it isn't rewarded by going to Spain or France, it's punished. I actually Googled and found out that orthopedic parts, limbs are being made in Italy. But that's not an invention there, they just improved on it. But money does go to where it's rewarded. The Abraham Accord, I would think, Michelle, going back to what you were saying, that the Middle East is going to be suffering. Wouldn't the Abraham Accord kind of catapult some of the trading in the Middle East?
I'm going to plead ignorance because I don't know anything about that, Ed.
Okay. So Ray,
Maybe somebody else does, but
any thoughts on the Abraham Accord and what it might do for prosperity in the Middle East?
Well, I think if it can materialize, it probably would lead to higher prosperity. I'm kind of dubious that it will be enacted simply because, from what I understand, whenever Trump brought it up on a call with various, Gulf state leaders the other day, they were kind of silent because it's just not politically feasible for them to sign on to that, given sort of what's happening in Gaza and Lebanon. So I would be surprised if that actually comes to pass. But if it were, I think that would be, a positive development.
All right, well, let's switch over to layoffs in different industries, because the job market is something that we track very strongly here, and it has a lot to do with where interest rates are going. If we have a strong employment market, then interest rates will remain relatively high. But we're seeing layoffs in banking and airlines, consumer retail. Where do you see the biggest pitfalls, Ray, in the employment industry, or in employment in what industries do you see them coming apart?
Well, to be honest with you, I don't have any industries top of mind that, would be disrupted, but I will have to say that I can see why there are layoffs just from, how AI is increased in its power and its usefulness. I've used it since, say, 2023, used it for very low level tasks. I tried to use it for coding a few years ago. It was okay. Sometimes it would waste my time. Sometimes it actually did what I wanted. But in the last 6 weeks, I feel like it's just been unbelievable in terms of the productivity boost it's given me. And so I can totally see how Ken Griffin, the CEO of Citadel, flashback a year, he was like, you scratch the surface on AI and it's garbage underneath. Now he's saying that it's completely automating jobs that very, elite quantitative researchers would take months to do. It's doing in minutes, hours, days. And so I do think that we're probably going to have continued layoffs in banking, logistics, airlines, manufacturing, consumer retail, et cetera, just because of sort of the increasing power of AI.
It'd be interesting to see what kind of cost savings each industry should expect to get, because that goes to the bottom line for earnings. Andrew, any thoughts on how that's going to impact technology?
Oh, it's greatly impacted. The sectors that Ray just mentioned before. Keep in mind that a dollar saved is a dollar earned, and this trend, it's going to be continuing for the next several quarters to come. Even though AI may or may not be helping all the companies to grow the top line revenue, but for the next few quarters, it's all about productivity gain and in maximizing efficiency by the use of the tech stack that are available. And as they improve, it's going to get even better. So banking, the banks have overhired since 2020 for COVID. They're just letting go the excess capacity now. Then the software adaptation with automation. For example, the risk officers, people who do research, analysts, a lot of them are being let go. Ken Griffin said it themselves. A team of 5 can be reduced down to a team of 2 or 3, right? I mean, Ray can absolutely, talk about that for sure. Logistics wise, we have less and less people that are doing the planning. We have less and less people that are doing the heavy lifting because of machineries and robots and so on. Then soon down the road, you're going to see autonomous technology that's going to also reduce the number of drivers out there. And then manufacturing, of course, you're going to have more and more automation, hardware and software side of things. And then the digitalization for consumption has also reduced. Look at many of the retail stores that are closing. You're going to start to see more and more people are buying different things that they would have bought at street level. They're doing it at Amazon as well, from car parts to groceries. These are the things that people are normalizing to buy stuff from online, that we never imagined that would happen 5-10 years ago. And so this whole AI enhanced digitalization consumption market is really help kickstart this continuation of layoffs. So we see it across the board.
So Michelle, supply chain strategy is also another way of using technology to become more efficient. Do you see certain industries kind of leaning on supply chain management more than others?
Interesting, because when I taught at UT Dallas, that was an up and coming major, was supply chain. And I think it still is. I haven't taught for a couple of years because there is a need, no matter what industry, for logistics, and there hasn't been as much emphasis on it. But there is now, obviously, because there are inefficiencies there, as I was talking about earlier, with the food and farming, and also with things like oil and energy. In general, commodities especially need to have more supply chain logistics involved. So yes, I think it will continue to be a good industry. But I will say I was on a call today with a seed capital company, venture capital company that I've invested in for probably almost 10 years. And they said the only place that you're seeing anybody willing to give any funding is if it's AI related. So very hard area right now in terms of continuing to get funding at a private level unless you use those initials. So I think that's why even with it, if it's logistics oriented, you're having to say, okay, I'm using AI in it, and then maybe you'll get some funding allocated to it.
Well, as we conclude here, as we do each week, Andrew and then Ray and Michelle, I want to see what stocks, based on this conversation, would you be allocating money to today? So Andrew, why don't you start us off?
Yeah, a couple of positions I would add to. I think Amazon, it's on its way to showcase its giant muscles. They are the largest employer of robots, and also some of the infrastructure play that will also benefit from this AI infrastructure build out. Companies like Ciena, CIEN, and also LITE. That they also provide lasers, in the communications. And then there's another company, a Nucor, they make steel. This commodity side of things, we're using a lot of steel in terms of, the infrastructure build out. And I think, with SpaceX, going IPO, steel is going to be one commodities that they're going to use quite a bit. And so that's all I have.
Okay. Ray, I'm catching you off guard there a little bit, but do you have an individual stock?
To be honest with you, I find it painful to follow individual companies. I tend to be purely macro, broad equity indices, sectors, commodities, currencies, bonds. But I would like to kind of highlight this thread that was on X about 2 weeks ago by Jeff Curry, former head of commodities at Goldman Sachs, who was pointing out the incredible relative pricing differential between what AI is trading at and what resource companies are trading at, given the demand for those resources, given the AI build out that we've all talked about here, Andrew and Michelle. If it's going to last multiple years, there's going to be an enormous demand for those resources. And we really If you go back to the 2010s, resources were in a secular bear market and there was really no investment in capacity. Everyone was buying the mega cap tech companies and still are. And we really haven't increased capacity there. So I think that there's going to be a sort of a catch-up trade where the resource companies, their prices will rise. Maybe AI kind of goes sideways after this enormous run. So I would be looking to, at resource companies.
Can you give me an example of a resource company?
Energy, materials, gold miners, silver miners, copper miners, other rare earth companies. It looks like the Trump administration might be putting price floors for minerals to kind of incentivize more capacity, because if the prices are suppressed because you want low prices as inputs, well, then there's no incentive to build capacity, and then we'll have shortages. So I think, you might start seeing price floors for minerals and metals, et cetera. And you want to be able to, have those resources because, China has leverage on us with rare earths. We might have some leverage on China with oil. It's just this big strategic game, but it all comes down to resources if you want to win the AI race and the other races that we're competing in. So yeah, I think resource companies will be where it's at the next 5 to 10 years.
Great. And Michelle, based on this conversation, what individual stocks do you recommend for our viewers?
I think the AI trade will continue for technology companies as well. Dell reports today. I think that will be interesting. Okta reports today. A lot of these companies are announcing partnerships with the semiconductor plays, like Dell is working very closely with NVIDIA, and that's why that stock has done very well year to date. Snowflake came back quite a bit after they reported yesterday. So SaaS companies, some of them may not be dead, and a lot of them are down 35%. So do your homework. I think there's some technology companies that still have some room to run and are not overly expensive.
Great. Well, thank you very much. Everyone watching, please reach out to Andrew Tang at Turner Financial Group, Michelle Connell at Portia Capital Management in Fort Worth, and Ray. I don't know if you want people reaching out to you, but if you
feel free.
Okay. So you can reach out to Ray at Ethos Financial Group. I'm Ed Butowski, and please share this link with your friends and coworkers, and we look forward to seeing you next week. Thank you.
Thank you. I'd like to add that what we have just gone through, it's really fun, but they're not investment advice. So thank you again, Ed.
Thank you.